Good evening. Good evening.
Good evening.
Good evening, sir.
Good evening. Hope everyone is safe from COVID.
Hope so.
Yeah. Where do you work, Senaga?
I'm at Softlogic, sir.
Softlogic
Softlogic retail.
retail. Okay.
Yeah, I'm working as a DGM there.
Okay. Okay. Nishant, are you there?
Yes, yes.
Yeah. So where do you work, Nishant?
I work for Sri Lanka Customs.
Customs. Okay. Okay.
Most needed people at the junction, no, sir?
Yes, sir. Yes. Yes. Yeah. And Shiran, are you there?
Yes, sir.
So where do you work, Shiran?
I'm into advertising, sir. I'm working at TBW Sri Lanka. It's a multinational agency.
Okay. Okay. Last batch, there was a girl from Gilby.
Ah, okay. Okay. Before I joined TBW, I was at Ogilvy.
Okay. Ah, right. Okay. And Nalaka, where do you work? Can you hear me, Nalaka? Nalaka, can you hear me? Okay. Is he on mute? Or? Then Sudarshan, are you there? Sudarshan? Sudarshan, sorry. Sudarshan, yeah. Okay, connecting. Dinusha?
Hi, sir. Yeah. Good
Yeah.
evening.
Yeah.
So, like,
Where do you work?
I'm working at Famous Pharmaceuticals
Okay, great.
in the consumer healthcare into marketing. I was basically handling the marketing for Sri Lankan motives. But from Monday onwards, I'll be joining a new company as the group head of marketing and business development. That's the KSP package. It's a group company.
Okay, okay, okay. Congratulations. And
Thanks, sir.
Jaiseelan?
Good evening, sir. Can you hear me, sir? Good evening.
Yeah, I can hear you.
Okay, so I'm working as a branch manager in CDB Finance, Vellavata branch.
CDB.
CDB Finance, yeah.
Okay, okay, good. Where is your branch?
Vellavata.
Right. Then Charita?
Yes, I work as a management trainee at Oral Corporation.
Orange, previous
Orange.
name,
Yes.
Orange, right? Yeah. Okay. Okay. Good.
Yes.
Then Shaminder.
I'm working at Sri Lanka Insurance.
Sri Lanka Insurance.
Yes.
Okay. Yeah. So there's an echo. I don't know. Yeah. So if you want insurance policies, you can talk to Shaminder.
No, sir. I am attached to legal department.
I don't know. We get an echo. You joined from 2 devices, so.
Sorry, sir.
Okay. 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 Then who else? Shiran, Supun. I think I spoke to you, right? Supun.
No. Hi, sir. I don't think so. Yeah, here I am. My name's Supun, and I work for a printing company, small printing company in Dagoda.
Okay. Okay. good. If there's a printing requirement, we can talk to you.
Yeah, by all means.
And Suranga?
Good evening, sir. I work for NDB Bank as a business banking department as a manager.
Okay, great. NDB. Yeah. Okay. So if I miss anyone,
I'm Nalaka.
yeah, Nalaka. Yeah. So there was an issue in connect.
Yeah, my voice was not coming through. I'm Nalaka. I was the sales and marketing director for Coca-Cola Tanzania. And I'm in between jobs now. I'm in Sri Lanka right now.
Okay, Nalaka, great. And the Sri Lanka Coca-Cola marketing director also one of the students and in the previous batch.
Last time, yeah, Shamal, he was there last time.
Yeah. And yeah, great. Then anyone of you all miss? No.
Yes, I am Dimukar.
Okay, Dimukar.
I'm from Stations. So I'm working as the Vice President, Supply Chain and Procurement.
Supply chain and procurement.
Yes.
Okay, good. So you have operations in Malaysia also, right?
Yes.
So one of my friend also work. I don't know whether he's still there.
What's his name?
I can't remember even his name. Sajado. I think he was strategic planning, director of strategic planning or corporate planning.
Station Group?
Not Stations. Yeah, this is this is not Stations. This is Carson's. Yeah, sorry. Yeah. Okay. Then let's start. If I miss anyone, then you can talk. Otherwise, we can start. And as I discussed in the first session, so please interact as much as possible. And so this is a mature audience and professionals with different backgrounds. So no right and wrong answers. So whatever the questions you have, if you have a doubt, you can raise, and that's not an issue, right? Okay, back to the presentation. And last week we discussed objectives of financial statement analysis, which we are going to discuss in detail in the first topic. But yeah, so at the moment, we need to understand the objective, right? We discussed 3 objectives: to assess or understand overall health of the organization. Right? So if I can highlight here, so overall health, then the financial performance, we are talking about performance, and the value, right? So 3 things, right, in general, right? So if you take different stakeholders, various stakeholders demand financial statements for different objectives, and shareholders' objectives might be different to the regulators. The regulators' objectives might be different to customers, right? But in general, we analyze financial statements to assess overall health of the organization and financial performance and the business value, right? So before continuing, are there any accountants in this audience? Let's say qualified accountants or part qualified accountants, just to understand the audience. Any accountants, CIMA, ACCA, CA? Right. The first day I noticed that they have auditors and okay. So if there are accountants, please bear with me. We need to lay a strong foundation, then it's easy for us to discuss advanced things. So we start from the beginning, right? Very basics. And then finally, we are going to do even business valuations, right? So the same subject I teach for the Columbia University MBA. Those who are doing the finance special, MBA in finance special, and this is one of the last semester subject. So you can imagine most of the students are CA or ACCA or CIMA members, and with finance background, and they are MBA the specialized in finance, and this is final semester subject, right? But the way we discuss is different there and here, right? Here majority are non-accountants, non-finance professionals, and the way we discuss and way we understand things is different, right? The main reason is, in this class, you are not supposed to prepare financial statements, or you are not supposed to do a business valuation, right? So when I teach this subject to accountants or finance special teams, so then their objective is to prepare financial statements and also to do a business valuation. So they are valuation professionals, so they can work as valuation professionals. So therefore, teaching to valuation professionals, here audience is different, and therefore you need to understand. And so what you need to do is, you should be able to read and understand financial statements, right? You should be able to read and understand financial statements, and also you should be able to read and understand a business valuation report, right? So if you ask professional valuer to do a business valuation, you need to read and understand the valuation report. So why I say this is important, right? So there are a lot of valuation mistakes. If you analyze the valuations done by the investment banks, the world-class investment banks, world #1 investment banks, right? There are valuation mistakes, right? So even if you do a Google search, you can find there are a number of valuation mistakes, right? And done by the #1 consultancy firm in the world, #2 consultancy firm, #1 investment bank, but there are mistakes, right? Even in Sri Lanka, you can see similar issues. Therefore, even if you rely on a third-party professional valuer's report, so you need to do a due diligence on the report, whether this report is right or wrong. At least you should be able to read the report, and if there are fundamental mistakes, you can challenge, right? So the valuation for one of the Fortune 500 company, right, and carried out by the world #1 investment bank, and there was a big valuation mistakes, right? So when you do a business valuation, you can value equity or you can value the entire firm, right? So when you do a business valuation, you can value the entire business, which we are going to discuss in detail. Therefore, even if you don't understand, it's okay, right? And you can value the entire company, or you can value equity component or shareholders value, right? And if you forecast cash flows for equity holders, right, all these technical terms which we are going to discuss, right, you need to discount those cash flows by cost of equity, right? If we estimate cash flows for equity holders, we need to discount them by cost of equity. But in this company, they use weighted average cost of capital. So it's a fundamental valuation mistake. And also, again, there is another recent example. I think 1 or 2 years ago, this Walmart acquired Flipkart business in India, and they paid $20 billion to acquire this company, right? So Indian business, so they valued for $20 billion, right? So it is also treated as one of the valuation mistakes, right? So some world-class valuation professionals challenge the valuation, saying that this is overvalued. 20 billion is too much, right? So therefore, we need to understand those issues. And also, forget about the valuation. There are a number of bankers in this audience. If you want to make a credit decision, right? If you want to make a credit decision, you go through the financial statements and make a decision, right? You get the audited financial statements. You need to go through it and make a credit decision. You need to make a decision, right? Even before making decisions, you need to understand whether the financial statements are reliable, right? You don't need to appoint another auditor to do that. You can, after studying this subject, I am sure the one student from the previous batch, Vijay, told that you can identify the mistakes made by even the accountants, right? So therefore, before going through financial statements and before making decisions, you can understand whether the financial statements are accurate, whether there are fundamental mistakes in the financial statements, right? So all those things you can understand and after studying this subject. Therefore, initially we are going to start from very basics, right? So therefore, don't judge the things that we are going to discuss from first 2-3 days lectures. So we start from the beginning, right? We are going to discuss the components of the financial statements, how to prepare financial statements. Therefore, if there are accountants or if there are people with finance background, please bear with me. And this is only for 3-4 weeks. So thereafter, we are going to discuss advanced things, right? So remember, the objective is to assess overall health, performance, and estimate value, right? I will repeat. Why I repeat? So next week, most probably you will get a quiz on these things. And so overall objective is to assess overall health and evaluate performance and to estimate business value, right? So these are the objectives of, in general, objectives of financial statement analysis, right? So this is your course contents. I hope you got the textbook, and in that there are 12 topics, and we are going to discuss all these things. And so this is the syllabus, right? If you can read and understand this, that's enough. And also, as I told you on the first day, so if you attend the class and if you spend the lecture time effectively, I am sure you can get a distinction irrespective of your background, whether you are an engineer, whether you are a lawyer or HR person. So irrespective of that, you can get a high distinction if you pay your attention, right? So the topic 1 is a framework for business analysis and valuation using financial statements, right? So this is the introduction to do a business valuation. So what are the steps that we need to follow? So which we are going to discuss. And also some of the steps are here also as separate topics. So here we say that the second topic is strategy analysis, right? And also, can you remember I discussed Zoom valuation, right? So 2 years ago, 2018 or 19, just before COVID pandemic, the value was 18 billion, and now it's $107 billion, right? So therefore, when you value a company, you can't just look at the historical financial statements and value a business. You need to consider a lot of other factors, right? You need to understand the overall economy, whether we can expect the economic growth next year, next 5 years, right? So what's happening in the competition, right? So what kind of strategies adopted by the competitors? So what kind of regulations or changes in government policies that you can expect in next 5-6 years? And also the macroeconomic factors like exchange rate, inflation, interest rate, all these things are important. Therefore, to understand a business, and also you need to forecast future. To do that, together with historical financial statements, you need to do a background study. So the first thing that you are going to study is strategy analysis. So what kind of strategy that they use, you need to understand, right? So those days we gave less priority for this kind of areas, but to understand the overall strength of the organization and also their performance, to estimate value, you need to understand the strategy of the organization, right? So we are going to discuss. And then accounting analysis. So this is, after discussing this topic, we analyze how to assess reliability of financial statements, whether there are accounting distortions. If there are accounting distortions, when you do a valuation, you need to undo them. You need to correct them, right? So whether the financial statements are audited, whether there is an audit committee, and whether the corporate governance are practiced in this organization, all these things are important under this accounting analysis. And also what kind of accounting strategy that they use, right? Even for accountants, there are strategies to prepare financial statements. Some are aggressive in reporting profits. Some are conservative, right? So you need to understand those things. Then earnings and balance sheet management, right? So companies manipulate financial statements, right? Not only in Sri Lanka, it's happening globally, right? So one case that we are going to discuss, the global case study, that's Lehman Brothers, those days world's biggest investment bank. And the size of the manipulation, $50 billion. Imagine the manipulation size, $50 billion in this country. And also we are going to take Sri Lankan case study also, right? So we are going to discuss Haley's MGT, right? Those days known as Haley's MGT, now Haley's Fabrics, right? This is some time back, but this is very important. And we are going to discuss how financial statements are manipulated. And so therefore, before going through, you need to be mindful of those manipulations also. Then the fifth topic is very important, financial ratios. So most of you all know GP ratio, net profit ratio, return on equity, return on assets. There are a number of ratios. So how to use them effectively, and how to interpret financial statement, or how to understand the story behind numbers by using ratios, right? So when we see the financial statement, you should be able to create a picture or a story by using the numbers in the financial statement. So this financial ratio analysis will be useful for you to understand the story behind numbers, right? And then prospective analysis, looking at the history, looking at the financial statements, looking at strategy of the organization. Then you need to understand, or you need to forecast future. If I forecast next year profit, so what would be the profits? And operating cash flows next 5 years, 6 years. So we need to forecast. So this is prospective analysis. So then 7 and 8 valuation, right? Under this topic, we are going to discuss different valuation models, right? And also the same model you can't apply to any organization, or same model is not suitable to apply to two different companies, right? You need to understand valuation, right? So we are going to discuss asset-based valuation model. We are going to discuss cash flow-based valuation, and also we are going to discuss relative valuation, right? So it's not rocket science. It's very easy, simple, right? It's not that difficult. Valuation. So as I told you, asset-based, even now you can do. Just look at the balance sheet and take the net asset value. So that's the value. So that's what I told you at on the first day. So by looking at the balance sheet, you should be able to give at least some figure. So this is the value of the business, right? And also by forecasting cash flows, then you discount and you can calculate the value, estimate the value. So another valuation. And how do you value your car? Let's say you want to sell your vehicle, car. How do you value it? Huh? How do you value your car? Huh? Nalaga, how do you value it?
Mileage run, registered
mileage.
year,
Okay.
registered year, model, and then maybe the damages or the wear and tear of the tires and all those things comes into play.
Okay, okay. No, my simple question is, you look at all those things, how do you value? Let's say you want to sell your vehicle tomorrow. How do you value it?
Compare with the market.
Market
Compare
value.
with the market. Yes. How do you compare with the market? How do you compare with the market?
Looking at the similar models, looking at the similar
models, yes. If I have a Maruti, so to sell a Maruti, I need to go to ikman.lk or whatever the websites and see the prices of a similar vehicle. Right? So this is called relative valuation. In relation to another assets, we value an asset. Relative. Right? So if you want to value your vehicle, what you do is go to ikman.lk and select similar brands and similar year of manufacturing and other options also. So then you check the values. You can get a rough idea whether this is 15 million or 10 million or 20 million. You can get a rough idea. And also, as Nalaka said, you need to do a little customization. You can't take the values as it is, and your value, your vehicle and the values appearing in the website might not be the identical vehicles. There can be differences. So the age of the vehicle you need to consider, the quality of the vehicle, other options available. Considering that, you do a customization. You increase your value or discount your value. It's called relative valuation. Right? So under this valuation, when we value a company, we value by using three different models: asset base, cash flow base, and relative valuation, which we are going to discuss. Right? These are separate topics. Therefore, don't worry. Right? We are going to discuss all these things. Then security analysis and credit risk analysis and takeover, financial policy. All these things we are going to discuss. I'm not going to discuss all the contents in detail. Right? There are the bankers. Right? So it's very important for you to understand the credit risk, how to assess credit risk, and also takeover. If you are interested in acquiring a company, right? You need to understand the difference between acquisition and a merger and takeover, right? And how to do a valuation when there is a merger, right? So which we are going to discuss under takeover, and financial policy, right? I think Sanjeev also discussed the objectives of financial management, right? So we need to make different decisions, right? In finance, we need to make different decisions. What kind of decisions you make? From Sanjeev's lecture? Huh? What kind of decisions? So in financial management also, we need to make different decisions. What kind of decisions you make? Huh?
Investment decisions.
Investment decisions, Yoga, yes. Investment decisions. We need to invest money in different investments. So therefore, we need to make investment decisions. Right? Investment decisions. Then what are the other decisions, other type of finance decisions you make, or the decisions you make? Investment decisions. Examples for investment decisions? Company? Examples for investment decisions?
Taking shares of another company.
Yes.
Sorry?
Taking shares of another company.
Okay. Invest in shares of another
Shares,
company.
yeah.
Yes, yes. It's the
Expansion.
investment. Sorry?
Expansion.
Yeah, Nalaga?
Expansion. You invest
Expansion,
in
yes, yes.
new
So your
product
current,
lines,
current capacity is, let's say, 1,000 kilos or 1,000 metric tons, 1,000 bottles, whatever capacity, right? So you decide to expand it. You decide to double your capacity. It's an investment decision. Yes. Any other investment decisions? Any other investment decisions you make?
Investing in a different portfolio segmentation.
Yeah, different portfolios, right? Yes.
Whether to invest in FDs?
Yeah, invest in FDs, yes. Right. So he was talking about portfolios.
Product diversification and enter into the new market segment
Okay,
also
okay,
coming under.
diversification. So all these technical terms are important, right? Portfolio. What's the meaning of portfolio in finance?
Investing in different type of segments.
Okay, different segments.
Rather than investing in one objective,
okay,
the money could be invested in several objective. I mean the portfolios.
Okay, simple definition for a portfolio in general. The meaning of portfolio.
The combination of product mix.
Yes, a collection. A collection. In finance, we say it's better to have a portfolio of assets, portfolio of investments, rather than investing everything in one asset. Right? So in finance, we say don't put all the eggs in one basket. If you drop it, you lose the entire thing. Right? It's a portfolio, a collection of assets, collection of investments. Right? So therefore, when you invest, you prefer to invest in a portfolio rather than investing in a single asset. Yeah. So yeah, any other investments? Investment decisions or investments you make as a business?
As you said, the mergers and acquisition in a different takeover.
Okay, mergers and acquisitions, takeover, yes. Yeah, what are the other kind of decisions you make? Yeah, somebody wants.
You invest in people, training, and those things.
Okay, investing in people. Yes. Yes, it's an investment. Yes. Right, investing in people.
Product development, new product development, new product development.
New product development, yes. And what are the now we discuss a lot of examples about investments, right? And what are the other finance decisions you make? Investment decisions. Next category of decisions. Now you have you decided to invest in different investments, assets. Second decision, second important decisions. I think Sanjay discussed. In finance, financing decision. Financing decisions. Right? So you need to invest your money and also you need to find money. You need to raise money for the business. Is financing. How you raise money for the business is financing, whether it's from the shareholders, whether it's from the retained profits, whether it's from the banks, whether it's from the debentures, whether it's from the commercial papers, right? So we need to understand how you are going to raise money for the business. To invest, so after making an investment decision, you need money to invest. So how you raise money is your investments, right? Investment decisions. So therefore, and there are other decisions also which we are not going to discuss. So dividend decisions, so we need to make decisions, right? So this is your syllabus, and this is very important, very useful, and I'm sure after studying this. So you can add value to your organization. So therefore, pay your attention and also interact. Right. Now let's see the components of financial statements. Last week we discussed. Right. Again, accountants, please bear with me. I know these are the very simple things for you, but we need to help other professionals. Right. So they also know all these things, but the one my request is, so whatever the thing you have already learned, please unlearn, right? And create a vacuum in your mind, then it's easy for us to discuss. Right? I know you all know all these things, but look at it in a different way. The way we discuss here in this class, the same documents, totally different to the O-level class, A-level class. Right? So therefore, don't think that these are very basic things, right? To discuss advanced things, we know all those things. Okay. Yes. So somebody said, so investment decisions and divestments. Yes, it's also part of investment. When we say investment decisions, not only investments. So after investing, you need to divest them one day. So that's also investment decision, right? You buy investments or you buy assets and you sell assets. Both are investment decisions. Yes, right. So going back to this components of financial statements, statement of financial position, right? Accountants can help us, and statement of financial position. We prepare this for a period or as at a date. We prepare balance sheet or statement of financial position for a period, for a year, or as at a date.
As at a date.
Sorry?
As at a date.
As at a date. Why we say as at a date, not for a period?
So it's the financial position at that time.
Yeah, financial position. Right? So can't we prepare it for a period? Balance sheet can't be made for a period. No, you can't prepare it for a period. So this is a snapshot as at a point in time. Right? So balance sheet is a snapshot of your assets and liabilities as at a particular time. Right? Even if you prepare a balance sheet in the morning for the organization and evening the balance sheet for the same organization, so the balance sheets might be different. Right? So if there are transactions, so the balance sheet in the morning and the balance sheet in the evening is different. Therefore, we prepare balance sheet as at a date. The balance sheet as at 31st March 2020. The meaning is assets and liabilities as at the end of the day, 31st. Even morning different, right? That's why we say we prepare financial position as at a date, as at a particular date. Then
so what are the standard dates that you prepare, monthly or quarterly, or how does it work?
No, not like those days, Nalaka. Now this preparation of accounting is automated, most of the organizations, right? If you want to see the balance sheet in the morning, balance sheet in the evening, balance sheet noon, so all you can do, right? No standard. Whenever you want, you can see the balance sheet. Normally what you do is traditional way, we prepare financial statements and the balance sheet end of the month, end of the quarter, end of the year, right? But there is no standard as such, and most of the accounting processes are automated, and therefore whenever you want, you can run an income statement, balance sheet, cash flow statement, right? Not like those days. So when we prepare income statement, balance sheet by using manual ledgers, right? You can't do that practically. but with the automation, now you can do that. Yeah. Right. So we are going to discuss all these statements in detail, but before that, statement of profit or loss and other comprehensive income for the period. Right. Second report is income statement. Right. So this one we prepare for a period. The first one is as at a date. This is for a period. Income and expenses for the year. Income and expenses for the month. Income and expenses for the quarter. Right? Period. Balance sheet as at a date. And the profit and loss for a period. You can run it for a day, month, year, week, right? Yes. And then statement of changes in equity. Right? Statement of changes in equity. Right? Changes in equity. Right? Again, you can see the value of equity as at the balance sheet date or as at a particular date, but together with the movement. You can see the opening balance. You can see the transactions or movement during the year or a period, and you can see the closing balance in statement of changes in equity. Then statement of cash flows for the period. Again, for a period. 1 year, 1 month, quarter. So whatever the period you want, you can prepare a cash flow statement. Right? And notes and other things also. So if it is balance sheet note as a particular date, and if it is income statement note for a period, right? So these are the components of the financial statements. Right. Now, let's prepare the income statement and a balance sheet. Right. So I am going to share with you an Excel sheet. Can you see the Excel sheet? Can you see the Excel sheet?
Yes.
Okay. Right. So this is a traditional balance sheet. Right. This is a traditional balance sheet. The way you present, you can change, right? You don't need to present in this way. And this is easy to understand. That's why I wanted to present by using this traditional format. Right. And so we were talking about two things. Two finance decisions, investment decisions and financing decisions. Right. So all your investment and financing decisions you can see from the balance sheet. Can we see the investment decisions and financing decisions from the balance sheet?
Yes.
Yeah. Ahmad, how do you see the investment decisions from the balance sheet?
It's like it comes through the assets part, non-current and current, and financing decision goes through equity and liabilities.
Yes, yes, right. So again, I am explaining this for non-accountants, right? So balance sheets, there are two sides. So this right hand side, this side is called the asset side. This part is called the asset side, right? So you can see assets, right? And also this side is called equity and liabilities. Equity and liabilities, right? So now we are using different technical jargons, technical terms. Right? So when I am going to share with you the technical terms. Even if you do a Google search, I'm sure you can find all the technical terms. But let's say here we are using assets and equity and liabilities, right? So how do you differentiate an asset and expense? how do you differentiate asset from an expense?
Is the expense equal to liabilities or what?
Expense equal to liabilities? No.
No.
So how do you classify, right? Both are expenses.
Yeah, at the
To
asset,
acquire asset, you need to spend money.
asset
Even
can
though
be
expenses,
controlled.
you need to incur some cost or expenses. Yeah.
Assets,
Ahmed?
assets are the resource which are controlled by the organization or the entity.
Okay. Yeah. So Ahmed, what as you said, assets are the resources controlled by the organization, right? Then expenses. Do you incur a cost to acquire an asset? Do you need to incur a cost to acquire an asset?
No cost in.
Yes.
Yes. You incur a cost to acquire an asset. Then what about expense? Advertising expense. So why don't you treat it as an asset? Huh? So how do you differentiate asset and expense? Nishanta?
It won't stay in the company.
It won't stay in the company. Yes. I like these simple terms. Right? Yes.
And
right.
Assets have future economic benefits.
Exactly. Yes. Yeah, Dilshan. Right? So if there is an asset, as somebody said, this is a resource. And it can generate future value. Right? So if it is asset, there is a future value in that. Right? So all these definitions we are going to discuss, but at the moment, just to discuss the balance sheet. So asset is a resource owned by the organization, and also there is a future value in them. So therefore, this side we record assets. Right? So, and also we classify assets as current and non-current. Right? So we classify assets as current and non-current. How do you do this classification?
Based on the liquidity.
Based on the liquidity. Yes, you are correct. So what is meant by liquidity? A lot of technical terms.
How fast you can make an asset to cash?
Yeah, how fast you can convert it into cash, liquidate it into cash. Yes, called liquidity. Right? So the assets that you can convert to cash in 1 year or less than 1 year are treated as current assets. Right? So we are going to discuss, but just to understand the balance sheet, otherwise it's difficult to understand. Right? So the definitions you will get, we are going to discuss. Right? So assets are resources, and some assets you can liquidate, you can receive money, you can convert it into cash within short period of time, or are called current assets. There are some assets which you can't convert to cash within short period of time. So for that you need some time, more than 1 year. So those are called non-current assets.
Examples?
Yeah. Examples for non-current assets?
Yeah.
Land, building.
Plant and equipment.
Land, building, yes, plant, machinery.
Materials.
Yeah. And also this in general.
And you can sell immediately, no?
Yeah. It's a good question, right? When we teach accounting to non-accountants, it's interesting. Right? We get different questions, right? So they look at things in a different way, especially engineers. So there is a lot of the questions in different way, even marketers, right? I like that, right? So it's a good question, Nalaka. You said we say land is a non-current assets, but Nalaka is telling if you want, you can sell a land.
I'm a salesman, I'm a marketer, I can sell it immediately.
Yes, Nalaka. Yeah. So salesmen are good at selling anything.
Yeah.
Right? So even a property, if you are asked to sell, you can sell it. So
Yeah.
that's his concern. Yeah, what you say is correct, Nalaka. You need to understand the objective of the investment in land. A land for prime lands is a non-current asset. Their objective is to resell it. Their core business is selling assets, right? So therefore, a company like Prime Lands, their land stock is stock. It's similar to inventories. Their objective is to sell them, right? But a company like, let's say, Bank of Ceylon, right? So their head office land, their objective is not to sell. I don't know whether they are going to sell it. I also heard that. So for this tourism and other things, right? So, but in general, their objective is not to sell that property. Therefore, even if it is a land for a company, in general, it's a non-current assets, but land sales, companies selling properties is not a current asset for them. And even Prime Land's head office building or head office land, right? So that is a non-current asset. Though they sell lands, so this property is a non-current. So this classification,
it depends on the basic objective of the business organization.
exactly. Yes. Objective of the we need to understand the objective of the business. Even non-current assets you can sell, but that's not your core business, right? So if you want, you can sell your vehicle. If you want, you can sell your machineries, right? And let's say Piramal Gas, if they want, they can sell their plants, right? So, but that's not their core business. That's not their normal operations, right? So to differentiate the non-current, current, right? You need to understand the business, the objective also, as Dishan said. Yes, right? So therefore, in this side, right? Can you see this side? Asset sides, you can see the investments, right? Long-term investment, short-term investments. Current assets, non-current assets. Non-current assets are long-term and current assets are short-term. So therefore, by looking at the asset side of the balance sheet, you can understand a company's investment decisions, right? Company's investment decisions. Why you treat acquisition of a land or a building as an investment decision? My question is, why you treat acquisition of a land, or forget about land, right? And you are into manufacturing, and you decided to buy a plant for your manufacturing process. Why you treat it as investments?
That generates income over the period.
That generates income over the period.
That generate additional income as well, like apart from your current income. So
okay.
it generates additional income for the time period what you're investing in.
Okay. Yeah. So it's too early, but there are three different type of decisions: investment, financing, and operating. Right? Investments, financing, and operations. When you go through the cash flow statement, with the cash flow we are going to discuss, right? Investments, financing, and operations, right? So acquisition of plant we treat as an investment decision, not as operating decision, right? Acquisition of a plant, acquisition of a vehicle, acquisition of office building, construction of an office building, right? All these are required for operations, but when you prepare cash flow statement, income statement, we treat them as operating decisions. Sorry, investment decisions. Investment decisions, yes. Right? Why we say these are investment decisions? These are investments. Why we say these are investments, not operations?
It will generate income.
It will generate income. Yes. Yes. Why you classify them as investments, not as operations?
Those can be used for future.
Those can be used for
future projects, and those, let's say, if a company acquired land,
okay,
the value of the land would be greater than the present land value after 5 years. Then automatically the balance sheet in the normally everyone evaluate the balance sheet. So as you know, the balance sheet will reflect in a different way.
Okay. Right.
So if you invest, if you place a FD in a bank, normally the annual effective rate is it's about 6 to 7%.
Okay.
Rather than investing money in a bank, they can go for a fixed asset investment. Then the decision would be greater than this option.
Okay. Right. Okay. I'll put it a different way. Right. So somebody from us, right? Hemas, I think
yes, sir. Yeah.
Yeah.
It's me.
So yeah. So do you know Hemas started selling soap without owning a soap plant?
Yes, with the contract manufacturing.
Yes. Right. So those days Unilever had their own plant, but Hemas, they started selling Baby Sheremy and other soaps. So without owning, or in other words, without investing in a plant. So that's why we say to sell properties, sell soap or FMCG products, you don't need to own a machine or plant. You can outsource it. You decide to invest in a plant. So therefore, you treat it as an investment decision. Right? So sometimes we buy vehicles as investments. The meaning is not that appreciation in the vehicle prices like these days, right? So you check the vehicle price today and in morning and evening, the prices is 10 to 15%, there's an increase, right? So if as a business, you decide to invest in vehicles, to do your business, you don't need to own vehicles. So there are a lot of other ways to do that, right? You can hire it, you can rent a vehicle, or you can use companies like PickMe or Uber, right, for your transportation requirements. And so you don't need to own a vehicle, right? So therefore, even office building, head office building, right, it's an investment decision. If you want to run a bank, you don't need to own a building, right? You can rent a place and run the business. Therefore, it's an investment decision. Therefore, acquisition of property, plant, and equipment, all these are treated as investment decisions. Therefore, from the balance sheet, right-hand side, you can see the outcome of your investment decisions. So these are your investment decisions. You decided to invest in properties, plant, investment assets, right? Fixed deposits, debentures, and inventories, debtors, even cash, right? So all these are treated as investments, this side, right? Then what about this side, this part? So this side we can treat as investments. And this side, you can see financing. Financing, right? So this side, this side is financing, this side is investments, right? To do the business, you need investments. And also to do investments, you need money. You need money. How you raise money, you can see from the balance sheet left hand side. So we call it equity and liabilities. Equity and liabilities. Again, two terms we need to discuss. Equity, right? Again, accountants, please bear with me, right? You all can teach equity, all these technical terms, but for the benefit of sales, marketing, and other professionals, right? Yeah. So what's the meaning of equity?
Equity is the capital that you raise.
Equity is the capital, Ahmed?
Yeah, it's the capital that you raise for a business.
Capital you raise. Another way to define equity.
Owner's interest on interest of the business activity.
Okay, owner's interest in the business.
Or
yes.
Or they attribute money.
Okay.
From the owners.
Yeah, Dishan.
This is the money brought into the business by the owners.
Yeah, the money brought in to the business by the owners. Yeah, Nalaka? Yes. Yes. Right. Another name for equity. Another term for equity.
Capital. Share capital.
Equity and capital, are they same or different?
You have
equity
debt
and capital, are they same or different?
Different. You have debt capital.
Yeah, sometimes at the beginning, just you know, if it is a startup, you just started the business, so then equity and the capital might be equal, but in general, equity and capital, two different things, right? And another name for equity. Nalaka told one thing.
Owner share.
Ordinary shares.
Owner share. Owners.
Yeah, owners contribution.
Owners
right?
money.
Yeah, owners money. The technical term used in the accountants can help now. Right? How the equity, another name for this? Shareholders fund. Shareholders fund. Another name for this. Equity. Shareholders fund. Shareholders fund. Another name for shareholders fund. Another name for shareholders fund. Huh? Another name for shareholders fund.
Shares.
Shares. Okay, let me explain the difference between capital and equity. Then I think it's easy. Hope you can see what I type here, right? Equity. Yeah. Okay. When you say equity, stated capital
retained earnings
plus reserves. Right? So when we say equity, there are two components, stated capital and reserves. Stated capital and reserves. Right? Reserves in general normally you have retained profits plus revaluation reserve. So you get other reserves also. I'm not going to explain them now, right? So equity, another name for equity shareholders fund, consists of stated capital and reserves.
What is stated capital? What is stated capital? What is the meaning of stated?
Yes, right. So those days we say share capital. So this is the capital provided by the shareholders initially. Let's say when you start a business, you put the seed capital or initial capital. Right? Or even after some time, you can do a rights issue. You can do a rights issue and you can infuse further more capital. Right? So this is the stated capital is the capital provided by the shareholders, capital provided by the shareholders, or in other words, money raised from the shareholders directly. Money raised from the shareholders directly. For the business, you issue shares and get shareholders' money. So that amount is called stated capital. Right? If you issue let's say 100 shares and the share price is 10 rupees, you receive 1,000 rupees. So that's the stated capital. Stated capital. The original amount you raise from the shareholders. Remember, original amount you raise from the shareholders. Right? But when we say equity or shareholders fund, in addition to the original amount invested by them, there are internally generated profits. So that's also belongs to the shareholders. Therefore, that is also part of shareholders fund. Therefore, retained profit also, the profit retained in the business also is treated as part of equity, part of shareholders fund. Shareholders, they don't give you money, but what they do is the profit generated by the business is shareholders can pay as dividends. So if they want, they can take the money back by way of dividends. Right? Without taking retained profit as dividends, they retain in the business for their reinvestments. So therefore, it's also part of equity, part of shareholders fund. Right? So it's clear, retained profits, why it's part of shareholders. The profit retained in the business, the profit is the residual amount. So after paying all expenses, the remaining amount is the profit. So that belongs to the shareholders. So therefore, it's, if you don't
if it
pay
is a
it
quoted, if it is a quoted company in the share market, if the price has gone up, how do get the whatever the return profits?
Okay, sorry.
No, if it is a quoted company, if it is in the share market,
okay,
if the price is going up,
okay,
then how do you say that the stated capital and the increase value?
Okay, okay, it's a good point, right? When we say stated capital, I mentioned that this is the original amount received from the shareholders. Original amount received from the shareholders, right? For a share, if you pay 10 rupees at the beginning, at the time of the share issue, and the current market value of the share is 100 rupees, we don't take that 100. We take only 10, right? Original amount raised from the shareholders is the stated capital, right? So what you mentioned, if you take number of shares into the current market price of a share, we call it market capitalization.
Okay.
Market capitalization, market cap, right? Market value of shareholders' equity. Market capitalization. This is not market capitalization. This is stated capital. So this is the original amount.
That one indicate in the balance sheet anyway.
No. You can't see the market capitalization from the balance sheet. Yes. Right. And then I explain why retained profit is also part of equity. So then the third part is revaluation reserve. Revaluation reserve. Right. So sometime back 15-20 years ago, I worked for CT Holdings Group or Cargill Group company, right? And as a head of finance, and so then at that time, when Mr. Anthony Page was the chairman, and he used to revalue properties every year, right? So he tell us revalue properties, and also when you prepare a budget for the year, and he need a minimum return on equity, right? When you prepare a budget, so they say we need 20% return on equity, right? When you revalue your assets every year, you increase your the equity value also, right? let's say you buy a property today for 100 rupees, 100 million. After 10 years time, the value of the land is not 100 million, now is 1 billion. 10 years ago, we used shareholders fund to buy a land or whatever the funds to buy a land, and the value of the land is 100 million, and after 10 years time, now it's 1 billion. And there is an increase in value. So that increase, whose contribution belongs to whom?
Owners.
Owners. Therefore, revaluation reserve also we treat as part of shareholders fund equity.
Yeah, excuse me.
Yeah.
So then now normal equation according to your Excel, that is the equity plus liability equals to assets. So when it comes to that example, the 10 million into 100 million, say 90 million asset gain is there. I mean the revaluation. So that means the equity, will it be mentioned under equity, or separately we will be mention the revaluation reserves like
No. We are going to put it under equity. Revaluation reserve also
directly under equity, and will be mentioned as accounting notes that we have been done the revaluation.
Yes. Right. So that's why I am going to discuss all these things with small examples. Right.
Yeah.
So if they are, let's say if the majority is accountants, we can't do that. But as majority is non-accountants, and so therefore we can do that. Right. We are going to discuss some examples. So we are going to do a revaluation also, Disha.
Okay.
I'm going to record 10-15 transactions, and we are going to prepare financial statements. And again, you don't need to prepare financial statements, but to understand financial statements, if you know how financial statements are prepared, then it's easy for you. So therefore, that's why we are starting from the very basics. So these are very basic, small, alphabet in accounting. Right? Okay. Then, therefore, equity, there are two components, stated capital and reserves. When we say reserves, mainly retained profits and revaluation reserves. Right? So I explain why retained profit is part of shareholders fund, and why revaluation reserve also is considered as part of shareholders fund. Right? And okay. So this is this balance sheet, as I told you, this side we call equity and liabilities. And also I mentioned this part is called, or we can see how we finance the business. Right? I will repeat, from this side, left-hand side, you can see how business finance their investments. Whether it's from the shareholders, whether it's from the debt holders, if it is debt holders, whether it's from banks, whether it's from debentures, all you can see from this side. Financing. Right? The same balance sheet, so which we study in grade 8 or 9. So now we are discussing in a different way. Right hand side you can see investments, left hand side you can see financing, how you raise money. Right? Your finance decisions, the capital structure, you can see from your left hand side. Right. Don't worry, even if you don't understand, we are going to take examples, right? So we are going to record transactions, right? So here, transactions we record, right? Okay, then we discuss equity and liabilities, right? So liabilities, the definitions we are going to discuss, but this is payables. Payables. Right? So liabilities are payables. Payables to the banks, payables to the debenture holders, payables to the creditors sometimes, payables to commercial paper holders, right? So we can raise from the shareholders or debt holders, right? We call it debt and equity. Capital structure. Capital structure, right? So it's a decision. It's a financing decision, right? What kind of a capital structure we are going to have is a financial decision. So decisions, financing decisions, you can see from the left-hand side of the balance sheet, balance sheet, equity and liabilities, right? So under liabilities, we can record bank loans payable, leases payable, commercial papers payable, all. Okay. And also, when we take total assets, if this is 100 rupees, so this is also the total equity and liabilities also should be 100. So that's why this statement is called balance sheet. The balance, right? So if you prepare financial statements accurately, the total assets and the total equity and liabilities value should be the same. You should be able to balance it, right? Is it clear? Any questions, any clarifications? And also, I think I told you the last day also, and don't wait till you get the feedback form to give you a feedback, right? So you can give your feedback then and there. If the things that we discussed too easy, they say these are too easy, we understand, and we can, speed up or we can accelerate. Otherwise, if I am too slow, also you can say it's too slow or too speed, right? So hope you understand the basic balance sheet. So this side assets, and if you write a formula for this, engineers,
that is the equity and liability plus equity and liability equals to assets.
Yes. Equity plus so now mathematics, assets. So small formula. Right? Yes.
How come all the assets that side equals to this side? Because your assets varies and you appreciate and all those things.
Okay. Yeah. So whatever the assets that you have, right? When you prepare balance sheet, we record them at historical cost, right? So normally you can see the cost of the assets, right? The amount you paid, right? And that's what we are going to explain with an example. But at the moment, let's say you buy an assets, let's say a vehicle 100, and to buy a vehicle you need money, right? Either you need to take money from the owners or from the banks, right? Let's assume that you get it from the owners, so then this is also 100, right? So we are going to explain this. You are going to prepare financial statements, Nalaka. So therefore, you understand, right? And why I do this exercise also, you need to understand. You make decisions, right? So sometimes if you are a salesperson, you say that I can sell this much of this quantity, and our production capacity is 100 double our capacity, right? You make a recommendation, invest 100 million, right? So then when you make this kind of decisions, you need to understand the impact of your decision to assets and the balance sheet financing side. From where are we going to finance this? Whether this is from the retained profits, or whether we are going to issue shares to we are going to raise money from the shareholders by issuing shares, or whether we are going to borrow money from the banks or any other debt instrument. We are going to issue any other debt instrument, right? And also, again, you need to understand the impact of your decision on your profitability, right? So what's the incremental sales that you are going to make if I do this investment? What's the additional cost that I need to incur, right? Direct cost, right? So what's your contribution from this, right? What's your additional income? What's your additional cost? And what's your contribution from this decision, right? And also, you can assess the impact of your decision to your cash flow statement, right? The timing of cash flows are very, very important, right? Most of the even big businesses collapse, right? Their sales are very good and they are profitable, but if you don't use the right source of finance with the right period, sometimes even the good business might collapse, right? So one good example is the finance company, right? So they take depositors' money, and depositors deposit money for 1 year, 2 year, 3 year, maximum 4 year, and they invested in schools, long-term investments, right? When you make investment decisions, you need to understand the maturity of assets as well as maturity of liabilities, right? So those who are in risk management divisions, they understand this maturity of assets. If you make an investment, so within how many years you are going to, get the money back. And also, the liabilities are source of finance. From where you get the money? You use a bank TOD and build a head office building. Is it a wise decision? To build a head office building, you are going to use a TOD?
No.
Is it a wise decision?
No, it's a wrong decision.
No, it's a wrong decision. There is a maturity gap. TOD, you need to settle on demand. When banks say settle this, you need to settle it. Can you realize money from the head office building immediately? No, there is a maturity gap, mismatch, right? When you make investment decisions, you need to understand those things, right? Maturity of assets and liabilities also you need to understand. So we call it risk management, right? So those who work for banks, they know, right? So they all the time classify maturity of assets and maturity of liabilities, right? And they say the maturity gap is this, right? First year, we need to settle 100 billion worth of liabilities, right? And even as a country, we are experiencing the same mistake, right? So we have invested in long-term assets by using short-term
obligations,
borrowings. Right? So we constructed ports, highways, their payback is 100 years, 50 years, 10, 20, 30 years, but you borrow money only for 5 years, 6 years. So after 5 years time, they ask for money. Can you realize them? You can realize them, but you need to sell the property. You need to sell the property also to them, right? So even as a country, we are experiencing the impact of maturity gap, right? So therefore, if it is a long-term investment, you need to find a long-term source of finance. Don't do that. Don't use short-term funds to finance long-term projects. Right? So it's a risk. We need to manage that. Right. Okay. So this is the balance sheet. And what's the time now? Can you have a break? Or
56.
I am flexible. Whatever the convenient time, whatever the time we want, we can have a break. Huh? Right? Okay. Can we have a break? 10 minutes or 15 minutes?
Yeah.
It's 7. Yeah. Let's say 8:15. 8:15.
Yes. Yes.
Okay. Please join back in at 8:15. Right. So then we can continue. Any questions from the things that we discussed so far?
So basically, from a layman's point of view, like this balancing act is like mainly based on predetermined sources and predetermined decisions,
okay.
And then you balance it, but not really practical way.
Really?
Not practical way. Like, say, for example, you put a land there, and then you
okay.
put the amount onto the other side, the equity and liability side, the land bought money.
Okay.
So,
okay.
It's same thing like you put it to the either side. Is that the way?
Yeah. The Nalaka, we are going to discuss some examples. So with that, you understand, I'm sure the doubts you have, you can clear. So when we discuss that, we are going to prepare a balance sheet by using some transactions. So with that, I'm sure I can clear your doubts.
Okay.
Right. So yeah. Okay. Then let's have a break and please join at 8:15. Right. Okay. Thank you.